So the risk level is going to be different for whatever your risk appetite is, but this is just what I do. This is how I approach risk. There are times that I will choose to go larger. I will mention maybe in the chat that, hey, I'm going larger. How we have it set up now, you're going to know everything I'm doing. It might just go over that 6 level. But it used to be 10 through 60 contracts if it was options, or 1,000 to 6,000 common. Now we're just took that down to just think of it as a unit of risk. And that 6 level, that max risk that generally speaking will be the max for me. Think of that as the most risk you're willing to put into something that might go to 0, into something within 3 days, into something on a swing frame, into something on an investment frame. If you're doing anything similar to me, I'm separating these as 3 different risk profiles, essentially. There's a different risk profile for my long-term investments. I put in that in an IRA account. I have more than one long-term investment account, and when I put stuff in there, I'm not looking at it. It's sitting in there, and I'm generally speaking adding to it until it either reaches the null or the trade doesn't work anymore, or targets. And these are long-term investments, high confidence. I'm not going into stuff that's highly volatile. That might be something whenever you're watching this video in maybe it's a couple of years from 2024 in November, maybe everything's highly volatile. It might not matter. But generally speaking, these are just to give some reference, these trades were swing. They got miscategorized. I don't ever really touch my long-term investment account trade. There used to be about 4 times during a trading year that you wanted to trade. If you traded those 4 inflection points from peak to trough, you made the most money. 4 times. Prior to 2020, it was about 2 times. And now it's more like 6. And I think that's going to increase moving forward. And that's why we're going to have the death of passive investing. If you're not getting trading from peak to trough, or that meat on the bone, at least in the middle, on these larger moves, you don't get paid the most money for making a day trade that's right, unless we're having a market that's like COVID. And you're getting the full move, these massive moves where you do have the day trading, because the next day it's going to have some rubber band snap back and going back and forth, ultimately lower. But you know who got paid the most on that are the guys that went short from the start, or long volatility from the start, and then bought at the bottom and didn't do anything. And they did the least amount of work, and they got paid the most. There was plenty of day trading that was fun and exciting, and that shouldn't be what you're looking for. But generally speaking, you're going to get paid the most for holding through the move and letting it pay you, because you found a good deal, and you're not giving it up easily. You want to get paid. You want to squeeze them by the balls because you got a good deal until it's a bad deal. Until it's a deal, you no longer, that 20 to 70 delta, that's what you want to be looking for. But generally speaking, if you're looking at these day trades, these risk level, you have to decide what you're willing to take it. What amount of money are you willing to take a zero? Like assign a dollar amount, a percentage of your account. I'm willing to take a zero with this amount of money, or I'm not going to day trade. I'm not going to, and that doesn't mean you can't day trade. There's plenty of times I enter a swing position and I end up day trading because it reaches the target, but I'm not looking to day trade. It just had a huge move, and I hit my target. I'm going to take. If I am, just a good rule of thumb, if you are taking day trades, you always want to, without even thinking about it, like put half the trade in at 100% of your entry, so you can take your risk out. Maybe the trade was worth 10 cents. In that case, might not be worth it to take your risk out, unless you put way too much size in. If you're going to go in 10 cents and you made a mistake and you sized up because you're having a moment, then you want to take your risk out. But make sure you add an extra penny for the commission. Overall, if I'm day trading out of the money option short frame, I want to get my risk out as soon as possible. I care less about I care more about taking my risk out and then seeing if I can get paid on that. I got in the trade because it can go 3 to 5x or 10x. And then I'll see if that can happen without having, it's a lot easier to let that work out when you don't have any risk in the trade. If you got all your risk in and you're waiting for that 10x and you're watching it go up and down and up and down, because these are going to move. They're designed. It's a game of poker. They know what you're thinking. They know what you're going to do. They know what the majority. They don't. You know how they think they know where your stop is. They just know where most of you will place your stops, and they're going to repeatedly prey upon that psychology. And you just got to know the game they're playing, and instead of playing into their hand, just follow their lead. But your risk level on these trades, understand I have a different account with a smaller amount of money. So I'm not putting as much risk into these trades. But generally speaking, that 6 level should never be over 2% of your account. Let's say you have less than 25K. If I had less than 25K, I can't say what you guys would do. If I had less than 25K, I'd probably be letting that get up to maybe 5 to 6% if it's a swing, not a day trade still. Because I'm about to go into day trading. Day trading, I'm still keeping that same threshold, but I'm using more capital. And I'm going to be incorporating more common stock trades. And common stock, it's eliminating, you have 100 delta risk. You're moving penny for penny, dollar for dollar. There is more risk, but you don't have time. Like if you believed in a swing trade and you're bullish or bearish, it should be much easier to hold. And like I'm trading, let's say some like UVXY here, I'm in an average price of 25.42, and my line in the sand is 23, and the upside is possibly up to 70, possibly to those August 2024 when we had that huge spike in volatility. We can get all the way up there, over $30 of upside for $3 of risk. Instead of getting crunched up and chewed and spit out by data, time decay, we've been trading different UVXY positions on options, and I've been taking my risk out at 100%, trimming, adding back when we come back to this zone every time. But I know I'm going to get paid the most on this equity position. But if you can't do equity, let's say if I was trading a smaller account, you could do stuff like synthetic longs, which would be going in the money, buying maybe 2 at the money contracts. Anything at the money is going to be 50 delta. You buy 2 of those, you're going to essentially have 100 shares of that, whatever you're trading. Unless as price moves up and down, that amount's going to decrease depending on the change. I'm going to not get into that on this video. But anyway, this risk level is still for me going to be around 2 to 3%. I will go up higher though on swing. Swing is where I make the bulk of my money. And it depends on, like, that was long-term investments. For long-term investments, when they pay me huge returns because I've held that for a year. And there are things like I bought Tesla at 160. I'm looking for a move over 300. We're trimming it like $100 higher. That's a long-term investment where I'm like, I'm sitting in this and I'm not looking at it. I believe in this and I'll add on dips. And maybe I'll trade a swing around that, but that swing I'm going to trade faster than the long-term investment that's my core, or vice versa. Sometimes it's a 90-day working thesis because these cycles are moving faster, volatility is increasing. Markets are going to become more volatile as we head into later stages in this inflationary cycle. There's just more leverage, more products, more people trading these products than ever before, and more risk and more opportunity if you know how to look at the market through these less conventional lenses, and kind of unlearning everything that you think you should know about markets. Fundamentals don't matter. I hate to break it to you, fundamentals don't matter. It's highly You can't time it. There's no, if you look at all the fundamental analysts and macro hedge funds, they're running around like a chicken with their head cut off and joining. And everyone knows options are the biggest game in town. It just depends on what you're trading. If you're trading pink sheets or penny stocks, yeah, you can maybe do something with a chart. But if you're trying to trade something with so many invisible hands and these different strings being pulled that you'll never see it on a chart, and you're going to react to it and think you're going to get paid, understand that it's designed to take your money from those people. Like, there's some unicorns. You're going to hear people say they're doing it. I guarantee you majority of them are lying. And then there's going to be some unicorns that are actually doing it in the old ways, and they're not ever telling you how they're doing it or sharing their work. Those guys are just doing their unicorn shit. They're just trading. They have no interest in talking to you. But this information this edge is so large, and it's growing. It's gotten more accurate. I can share it, and it's not affecting it. And when it ever affects the outcomes I'm looking for, trust me, you will not get this information. But for the time being, I have no inclination that it's being reduced by access to it. It might even be getting better. I don't know if I don't know if this edge will ever leave the market. I'm sure it will evolve and change, but for the time being, it exists, and we want to take advantage of that. And these risk levels, you'll see me, like I said, I will go over 6 at some points. And how you want to look at risk, like it's a lot easier to look at on an option contract because it's defined. You know the exact dollar amount that's at risk. It's a bit harder if something's worth $200, like coin, or like this is worth 25, 20, 26. You have to look at risk in relation to what is possible from 4 p.m. to 9:30 a.m. the next day Eastern. So just understand that anything that can't happen in markets will happen at some point or another. If you think a company is not going to get blown up to bits or some shit's going to happen overnight, one day you're going to wake up and the company's going to go out of business overnight, and you're going to be sitting there owning the stock or in some position that is adversely affected by it. It's just inevitable if you trade long enough. And once those events occur and you go through the process of realizing that everything will happen, and if you're not prepared for that, you're going to be reacting to new information while you need to be executing. So you need to have a plan to execute based on any possible outcome. So I know I'm getting out, and I know the volatility of these things as well. Like, I know that the likelihood of the market going up 500 points overnight is pretty low. And if that happens, volatility is probably going to increase with the market. So I'm probably still not going to lose. I might even make money on this UVXY trade. I want to be in positions where, generally speaking, I have more than one way to win, where it's a good deal based on the current paradigm that we're facing in, some usually 30 days, but 30 to 90 day window. And I'm taking advantage of an inefficiency in the market. I bought UVXY initially around 23, 24. The market was 200 points lower. Market has gone higher, and so has UVXY because volatility has increased. And I haven't really, I said after 5,700, after being long from 4,100, they can have it. It was not fun to trade long if you were trading during that period. A lot of stuff's off the highs. Some stuff's ripping. Some stuff's not. It's been not worth it to be long. This isn't the meat on the bone. This is the scraps, the penny in front of the steamroller. Maybe that changes, but for the time being, that's our current view at November 2024. And I'm getting way too into detail on stuff that doesn't relate to the risk. Just to get back to the risk, you might see me do like these 0.5s, 2.5. Just understand this is not like half a contract this used to be like 5 contracts related to a 10 contract per unit basis. And it's just trimming like based on that percentage of risk that you're associating with the unit. I'm associating 3%, sometimes 5% with a max core play, which is around 6. If I'm doing that, that could be whatever size I'm trading doesn't matter, but you have to find a risk appetite that is appropriate for you, that you're not on the edge of your seat, you're not watching every tick. You can have a large position open, it just can't go to zero overnight. Like if something is expiring in 90 days and it's an index play that's, worth $7, something like that, it's not going to zero tomorrow. It might go down. It's not going to zero. There might be a plan posted on how I'm going to approach this trade, how I'm going to approach this risk. You just have to be in things that, and accept you when you're wrong, but be in things where that defined risk, that level of risk you're willing to take is, if it's an option, it's based on that in the entire value of the contract, the notional value associated with how many you own and the price of the contracts on entry. And then if it's with common stock, it's in relation to your line in the sand or what's possible. Like let's say you're holding through earnings. There's a different risk level during that 24-hour window if you're holding overnight. It's not, and let's say you're holding in earnings and you're like, I have a stop $1 below. That's not going to work if the $20 stop run happens. Like there's different risks associated with that. I generally try to avoid events I have no control over. Long-term investment, I'll go way higher on risk. I'm concentrated. Go to like 10% of my account into like 4 plays. Long-term investment is, I believe in concentration, not diversification. I want to be concentrated in a couple positions that I know are going to continue to outperform based on we're in a leptocurtic market, meaning pendulum swings one end to the other. The things that are swinging the most will continue to swing more than other stuff. There's a reason there's buyers, there's price agnostic buyers on some of these things. The stuff that moves, the darlings that everyone wants to short, they're going to keep shorting it. And the people that are long and hedging it with puts, creating buyback, that's going to continue to move the most. Your NVIDIAs of the world, your coin, your MSTR. The stuff that has moved the most will continue to do so until the larger picture macro paradigm that we're in changes and we leave this bull run and start something new. But as long as we're in this bull run, and unless China invades Taiwan, NVIDIA is going to move more than other semis. MSTR is going to move more than either MSTR is Bitcoin, levered Bitcoin. Bitcoin is going to move more than other indexes because it's going to continue to, and it's the best Ponzi out there right now. It's just there's a lot of reasons that that's a separate video probably, but it's moved a lot. It's had the best returns. It's going to continue to likely have the best returns. You don't want to buy AMD to play catch up. You want to buy the stuff that's moving. This has gone beyond, exactly what I wanted to talk about in this video, but overall, how I'm approaching risk should not be how you approach risk because we are not the same person. We don't have the same account value. We are eventually going to get the portfolio into a place where it's going to have all the margin associated with any of these trades, based on like whatever, like 100K account, and you can change that number to your account based on my risk strategy. So you can kind of go in there, see what makes sense and tweak accordingly, and eventually be able to play around with the tool yourself once we optimize it and connect it to your brokerage and it tell you some insights into what you might want to change, where you're losing more money, where you might want to stop trading after 11 a.m. or start positioning into different, you make more money on spreads or this time frame or this product. and listen to that information. It is, if you're not reflecting or have a journal, you're never going to learn that information. You need to learn what you're doing wrong to do more things right. If you're just looking at what you do right, you're never going to learn. So overall, this is how I approach risk. I think it's best to separate into 3 separate accounts, maybe just mentally. Maybe you just separate one account mentally. This amount is allocated to this is this, and this is that. And stick to those guidelines. You want to have some rules-based system so that you can go back and tweak it to make it better. If you don't have a rules-based system or some defined approach to risk, you're going to make a lot of money, you're going to lose a lot of money, you're not going to know why. And you're going to continue doing the same shit, and hopefully you hit big and you get out of the market. But you probably won't. You'll probably continue, you hit big, and then you'll lose big. And then you'll just keep repeating the cycle, and you'll never really know any rhyme or reason as to why you're not worth hundreds of millions. If you want to make real money, it's not going to be day trading unless you're a unicorn, generally speaking, or you have a completely algo approach to markets and you're not a discretionary trader inputting your trades. If you're an algo trader and you're trading, millisecond inefficiencies, probably should day trade. There's tons of opportunity if you're able to take advantage of stuff that's happening and compete with those guys on millisecond time frames. Or you're selling volatility and you make money, you make a little bit of money most of the year, and then some shit happens that you can't really predict without information like this, and you risk losing all that money. Short volatility, just so you guys understand, is essentially the same risk as long volatility. If you look at it, any live test, back test over a long time frame, live test depends on how there's ways to finesse some of those blow-ups, but generally speaking, you're in just as much risk, selling iron condors or however these people are saying, like, yeah, there's going to be a really high win rate, but how much do you win when you win compared to how much you lose over the course and the amount of times you lose? You want to know if you have positive or negative expectancy value, which we will cover in another video, but hopefully you guys have a good idea of how to approach your account, or have a good idea of how you should think about approaching your account, and go hit the drawing board after looking through this. Thank you, and we'll have more videos posted on things like positive expectancy value. If you're in the group, we're gonna have some PDFs posted on how you can start looking at a set of data on your trades and seeing if it's profitable, whatever strategy you're looking at. You got to have positive expectancy value. It's not about win rate. You could win 1% of the time and win more than you lose over those 99% of the times you lose. Maybe you lose $1 99% of the time, and when you win that 1% of the time, you make 10K. That's a profitable strategy. You lost $99 over 100 trades. You lost $99, but you made 10K on the one time you won. So you made 9,000. You're profitable. You're highly profitable, but that's an extreme example. Just understand win rate doesn't mean shit. Win rate will never mean shit. Positive expectancy value. How much money do you make when you win compared to how much money over the amount of times you win compared to how much money you lose over over the course of all those losses. And if that number's positive, you have positive expectancy value with that data set, with that trading strategy. And then you can tweak it from there and see if it's worth tweaking. If it's a negative number, you probably are like looking at this like it's trash and you don't want to use it. You're losing money. Anyway, stop recording.